Hey everybody, we're back with another video to talk about basically your favorite time of year. What are you saying, dude? Christmas just ended. Now, I know that, but you know what? The first 4.5 months of every year is your favorite time of year and you didn't even know it. And what am I talking about? Tax season. I know, the dreaded tax season where you gotta end up getting all these receipts and itemize all these things that you're going to end up writing off and dealing with the IRS and your tax professional, or you're doing your easy form and all that stuff, all the nightmare that comes along with doing that. But nevertheless, it's death and taxes is something that we can't avoid. So here we are again, and I'm here to go ahead and prepare you for some things that you might not know about when it comes to writing some stuff off, when it comes to home ownership. So without further ado, let's get into this. So in this video, I want to basically impart some advantages as a homeowner when it comes to your taxes. Now understand that I am not a tax professional, so please advise your tax professional. For those of you who own a home, there are several costs associated with home ownership that allow you to write off in order for you to basically lower your taxable income. So if you're interested in what I'm about to talk about, get a pen and paper and write this stuff down. One of the things that you can deduct first is your mortgage interest. Yes, you can write off the interest you paid on your mortgage last year. Your lender should send you a document called a Form 1098. This will give you the exact amount of the interest you ended up paying. Second, you can deduct your private mortgage insurance, or what's known as PMI. And for those of you that are paying, you know exactly what I'm talking about. But if you don't know whether or not you're paying PMI, here's an easy way to know. If you put less than 20% down when you ended up purchasing your property, you most likely are paying PMI. To know exactly how much you paid last year, pull out your monthly mortgage statement and it should be in the breakdown of your monthly payments, such as your principal, interest, your escrow amount, and then your PMI amount. Third, you can deduct the amount you paid in property taxes. Mind blown. I was blown away by that too. You can deduct taxes from your taxes. What? Just know that there are limits to the amount of property taxes that you can write off. So no, if you're married and you're filing jointly, you can deduct up to $10,000 of property taxes and $5,000 if you are single or married filing separately. Fourth, renovations you've made to your home that are considered energy efficient can get you a credit of up to 10%. For example, skylights, outside doors and windows, insulation systems, roofs, as well as qualifying air conditioners, heating pumps, furnaces, water heaters, just to name a few. Installing solar panels on your property. So note this, in December of 2020, Congress passed an extension of the ITC, which provides you 26% tax credit for the systems installed in 2020 to 2022, but there's a reduction into that percentage. It goes down to 22% for systems installed in 2023. Now, obviously, we're not in 2023, but just note that if you're going to install some solar panels, that credit is going to end up being reduced down to 22% if you install solar panels in 2023. I have no idea what's going to end up happening in 2024 or later, but I'm sure that it's going to end up dropping, just so you know. You can write off necessary home improvements, and I emphasize the term necessary. So some of the necessary renovations would be for, say, medical reasons. A few examples of that might be, installing medical equipment, installing additional railings in your house, widening some doorways for necessary medical equipment and mobility, etc. Again, consult your tax professional for specifics on like qualifying improvements to your home, because we can't go through the whole list right now, and I know you're not interested in going through that. The fifth item that you can write off is home office expenses. If you operate a business in your home, you might be able to deduct some of the expenses that maintain that space. So the IRS requires that you use your home office for regular and exclusive business in order to qualify for that kind of deduction. Know that not all business falls under the category of a business expense, which sucks, I know, but it is what it is. So for those of you who use your office space when it's convenient or just working from home for your employer, you might not qualify. So just check that out with your tax professional. Now, if you're wondering how you determine how much of your home/office space you can deduct, determine the size or percentage of your home dedicated to the place of business. Another tax deduction applies to new homeowners. So if you bought a home last year, pay attention. So check this. You can write off some of your closing costs. I know, it's crazy and cool, but just note that you can write off some of your closing costs.
It's a write-off for them.
How is it a write-off?
They just write it off.
Write it off what?
Jerry, all these big companies, they write off everything.
You don't even know what a write-off is.
Do you?
No, I don't.
But they do. And they're the ones writing it off.
Buyers typically spend about 2.5% or higher of their loan amount on closing costs. So that can add up to a lot. Now, you won't be able to write off all of your closing costs. So if you're wondering how much you end up paying in closing costs, your lender should have given you what's called your closing disclosure. So your closing disclosure breaks down the individual costs that make up most of your closing costs minus your inspections and things like that. You can also find this on what's called your HUD-1. You can find your HUD-1 in that massive packet of paperwork you end up receiving when you ended up signing at closing. Now, those of you who purchased the property using a VA loan, you paid what's called a VA funding fee. Most veterans who buy or refinance a home with a VA loan have to pay a one-time funding fee. The amount of this funding fee is based on the type of your VA loan, how much money you are borrowing, and other factors. You can find the amount you paid on your final settlement statement. You either paid your VA funding fee in full at closing, or you rolled that cost into your loan and you're paying it over time. Note that some disabled veterans, for those of you that are disabled, and surviving spouses are exempt from paying this fee. So if you're planning on purchasing property later on in the future, just know that you should be avoiding having to pay that VA funding fee, which is nice for you. Now, being that I'm speaking to you veterans out there that purchase your property using a VA loan, understand that the PMI I mentioned earlier in this video is not something you guys are paying. When you get a VA loan, the PMI will not be applied to your loan. If you sold your home or you're thinking of selling your home, pay attention to the amount you net from the sale. I say this because you're trying to avoid paying what's called capital gains tax. This is another major benefit of home ownership, avoiding paying capital gains on this type of investment. So the tax law allows you to shelter a large amount of profit from the sale of your home. One way to avoid capital gains is if you are single and you own and lived in the property for at least 2 out of 5 years before the sale, then up to $250,000 of the profit is tax free. I know, Another freaking awesome benefit of being a homeowner. Now, if you're married and file a joint return, up to $500,000 of the profit is tax-free. Thus, in most cases, taxpayers don't owe any taxes on the proceeds from the sale of their house. The sucky part about being on the flip side of this is if you sell for a loss, you cannot take a deduction for the loss. I know. If your profit exceeds the $250,000 or the $500,000 limit, the excess is reported as a capital gains on your Schedule D. Now, we just went through what's called an itemized deduction, but you have the option to use what's called a standardized deduction when you file your taxes. So the difference is that you can take a standard or you can take an itemized deduction. Now, the IRS makes the standard deduction available to all tax filers. And in 2001, the standard deduction breaks down like this. For single and married individuals who file taxes separately, the standard deduction is $12,550. For those of you that are married and you file jointly, the standard deduction is $25,100. And for heads of households, the standard deduction is $18,800. Now, if you're considering taking advantage of these tax deductions we just talked about, then make sure that the total amount of your itemized deductions is larger than the standard deduction you're eligible for. Otherwise, it makes more financial sense to take advantage of the standardized deduction to keep your tax liabilities as low as possible. Hey, for those of you who are looking to purchase a property and are wanting an agent that cares more about your interest than theirs and is dedicated to ensuring that you get exactly what you're looking for while at the same time saving you money, great, because that's exactly the kind of agent that I am. I've been a licensed real estate agent in the state of Nevada since 2013, and in that time, I have helped many buyers find exactly what they're looking for while successfully negotiating the best terms and conditions on your behalf. I am also giving all of my buyers, which includes you, $1,000 towards your closing costs. So if you're serious about looking or purchasing a property, give me a call. Otherwise, I look forward to seeing you in the next video.